Here's the problem. The money we keep in a 401k, 403b, or IRA is typically charged fees of 1% to 2% for administrative services and management expenses, which will be deducted from our retirement savings every year, even when our accounts lose money. Now, 1% or 2% might not seem like much, but those deductions can be very costly, because every 1% we pay out in annual fees over 20 or 30 years will leave us with 20% to 30% less money at retirement, which will mean 20% to 30% less income, costing us hundreds or even thousands of dollars every month for the rest of our lives. So, what's the solution? A transfer or rollover of your retirement savings into an IRA with a contractual guarantee to earn an interest rate based only on the growth of an equity market index, like the S&P 500, the NASDAQ, or the Dow Jones Industrials, but net of any taxes, commissions, fees, or expenses. The solution is a contractual guarantee to grow and protect your savings, as well as the income you derive from your savings, for as long as you live without the risk of losing money, and without any fees for administrative services or management expenses. The solution is a fixed index annuity, and according to the U.S. Securities and Exchange Commission, more than $123 billion have already been deposited into contractually guaranteed fixed index annuities. Here's how they work. With a fixed index annuity, you don't actually invest in an equity market index. A fixed index annuity only uses the index to determine the interest rate it credits to your savings. And when the index increases or gains value over a period of time specified in the contract, an interest rate as a percentage of those gains is credited to your savings. But when the index decreases or loses value, no interest is credited to your savings, and those losses are never deducted, which means that your earnings are preserved and your savings are protected within the contract for as long as you live. However, there is a maximum limit on how much of the index gains can be credited in any one day, and a minimum number of years before those gains can be withdrawn. So you don't get all of the index gains, but you don't get any of the index losses. For example, if the index decreases by 10%, even if it loses 20, 30, or 40% of its value during any period of time, not $1 of your IRA money would ever be deducted from your fixed index annuity. Because a fixed index annuity is a long-term financial contract guaranteed by a legal reserve insurance company, subject to government regulation, and required to maintain capital reserves equal to all of its contractual guarantees. However, you could lose some of your IRA money in a fixed index annuity if you withdraw more than 10% of your savings in any 1 year. And of course, the IRS will charge a 10% tax penalty, in addition to income taxes, on any money you withdraw before age 60, which means that you can withdraw up to 10% of your fixed index annuity each and every year after age 60 without any interest or tax penalties. So ask yourself this. Does it make sense to keep paying fees every year out of your 401k, 403b, or IRA savings for administrative services and management expenses on top of the potential losses to your retirement money? Or does it make better sense to keep your retirement savings in a fixed index annuity with a contractual guarantee to grow your savings and protect your income for as long as you live, with interest earnings based only on the increase of a balanced and diversified equity market index, without any risk of losing your money, and without charging any fees for administrative services or management expenses?